Roy Mutooni from Sanlam Investments joins us for a closer look at what's playing itself out on the market scene. Thank you so much for your time, Roy. Quite a pleasing picture there with all those boards in the green. We are seeing, of course, a buying activity coming back into the markets after the bloodbath that we had Friday, Monday, and also a bit of yesterday. Was it only a matter of time before this rebound came?
Isn't that? Well, the thing is, like you say, it's happy days, but I think there's a couple of drivers here. Yes, the sell-off was quite brutal across all markets, but remember, the place where all of this started was in Tokyo and around the yen and the yen markets and that whole story about the carry trade.
Yeah.
There, the big risk was that these guys would keep hiking rates, even as the US looks to be bringing rates down. But they've given the assurance that they're not going to hike into market turbulence, which gives a sense of predictability within markets and a sense of understanding between the big central banks. So I think equity market players probably looked at that and figured, then we've got time. What we're waiting for now is to see what happens with the US. The yen is probably stable, and the policymakers there aren't going to go too much out of step.
Oh, but what a knee-jerk reaction there. So it's really quite encouraging that authorities there have kind of calmed the markets down and kind of reassured stability and I guess, monetary policy that is responsible. Let's go into China because we had some mixed trade data coming out of there for July. Exports, the growth there disappointing, but imports are actually encouraging and surprising to the upside. What's the story there?
So that's actually good news because what China's been struggling with is domestic demand.
Yes.
And how they've tried to rescue themselves is by subsidized exports or very low-cost exports into the rest of the world. And how you do that is by increasingly investing in your manufacturing capacity and your manufacturing ability. And you've seen how the rest of the world has responded with tariffs and complaints and everything. But their fundamental problem is that the Chinese consumer is not spending. The Chinese consumer is still saving, feels very insecure. So when you see imports coming in, that might mean that they're reaching into their pockets a little bit and spending, which should actually be quite good for that segment of the economy. Still very early days. I think the government there doesn't want to do what they did in the US or in Europe, which is basically put money in people's hands and force them to spend. So it's going to take a little bit of time. That property market is still over leverage, and that's where most people's wealth is. So for so long as they feel insecure about where their wealth is stored, it's unlikely that they'll go out and spend their cash savings, so to speak. So early days, but a positive pointer for sure.
All right. Well, let's go into some of the company news that came out of the JSE, including from JSE, the company. So the company coming out with interim results today, revenue growing over 4%, but there was a slight decline in headline earnings per share. CEO calling the performance stable. How would you describe it?
Well, remember that I think during the period in review, this was ahead of the elections, and activity across the whole economy was down. And I suppose trading as well, when you look at daily trading volumes, they were actually at very disappointing levels. So maybe it is truly a resilient performance. Subsequent to the elections, we've seen volumes pick up a little bit, volatility increasing, and this is what they like. We've also seen a couple of new listings, mostly through unbundlings, but we'll take everything that comes. So hopefully for them, you get more listings, you get more interest from international players, which increases volumes, and that helps their top line, because that's actually what drives headline earnings there. Big growth in top line will allow them leverage gains on their bottom line.
Very interesting point that you make that we also must be cognizant of that period where there was really that whole uncertainty before the elections where volumes were quite low. Let's go into QOLA, also another counter that also does, depend on market activity, releasing interim results. But that share price popping over 4%, it really seems that they knocked the ball out the park in every area. Talk to me about that performance.
So QOLA is a platform business which basically deals in wealth management. So they collect flows and take them to asset managers in the UK, and the asset managers invest and you get your returns in that way. During this period, the flows that came in were higher than expected.
Yeah.
And then the cost control, which is a program that they've been going through, came out with better results than expected. So you have better top line, better cost management, means your bottom line is going to be better. They've been going through a whole restructuring for a period of time, and it seems to be paying fruit. UK markets have moved positively as well. So yes, this was a performance that I think the market took a shine to. Positive surprise, long may it last.
Yes, indeed. Well, let's talk about Glencore. Of course, commodities have been very, very volatile, and we've seen the lackluster pricing of the commodities filtering through to the financial metrics of Glencore. Of course, we did have the results, but then also the announcement on the coal business. Let's actually start off with those numbers. What did you make of them?
Well, as always, commodity prices are down. Their production, interestingly enough, held up. So production was in line, but prices down means that your earnings are going to go down. That's what happens with these cyclically geared companies. So I don't think that was much of a surprise from the market. I think what the market was waiting more to hear was about this announcement and what the intention to do with coal was.
Well, there we go, because I think for me it was a surprise, because I mean this whole time we'd been expecting Glencore, after the acquisition of Teck's coal business, to demerge that coal business, but now seeming that shareholders are actually saying keep it.
Well, the thing is, remember what happened with the Anglos? They unbundled together, trebled and doubled and everything. I think coal is very profitable. And what these guys are looking at it as is a fantastic source of cash flow. Right now, post the Ukraine war, there's been a lot of demand for coal. Its prices have broadly held up. So they figure that what they want to do is basically hold on to this asset, generate cash, and reinvest that into the rest of their business. I think you'll find that they're now an interesting proposition. On the one side, they've got commodities like copper, which will help with decarbonization, and then they've got coal now, which will help with energy today. So that's very positive, I would say, and that's what I think investors are reacting to.
All right, very, very interesting. Roy, before we get to your stock pick, let's reflect on some of the counters that have found favor with some of your industry peers.
My stock pick on the theme of technology is ASML. It's the Dutch semiconductor equipment maker. The reason I like this company is they basically have a monopoly on semiconductor lithography equipment, which is a key component in actually making chips. And especially as the chips get more and more advanced, the cost of these machines, I mean, the latest generation sells for about 300 million euros for one single machine. They have a complete monopoly on this market.
Nikkei for you after the crash, it's down 23% in the last 3 days. It's called Yokohama Rubber company. Is it Yokohama Rubber or is it? I always forget, but it's Yokohama. And the company basically produces tires, conveyor belts, etc., all rubber products. It's trading at a single-digit PE and at the EV/EBITDA forward of about 3.5, 3.7, I think, after the recent fall in the share price. A lot of cash on the balance sheet, solid balance sheet, like most Japanese companies. And I do, not only because it's cheap and because it's fallen 23% in Japan and you need some Japan in your portfolio, whatever, no, I'm very bullish rubber.
I think SA banks are in a relatively good position. You're starting to see interest rates come down, which will put a little bit of release some pressure from the consumer on the mortgage loans, people paying off cars, etc. So I think they're going to get relief in the year, maybe 0.5% by the end of the year. So I think that's going to benefit their loan book and their bad debt book. At the same time, it's not going to be a big enough cut in rates, so they'll still be earning really good interest income. And I think they're very well capitalized, all the South African banks. And people, I think, are slightly underestimating, a good outcome of the elections and what it can mean, for finance for the banks, especially into renewable energy and to infrastructure product.
All right, Roy, let's actually start off with Yokohama Rubber. I'm not sure how closely you watch that one. Drika says he's bullish on rubber. Some people would just say, you know what, just be bullish on Japan. But quite interesting, after the moves that we've seen in the past few days and, of course, the way they're going in terms of monetary policy, there was a lot of bullishness on Japan. Would that still be maintained at this point or not?
So I think there's multiple levels to that answer. The thing about Japan is they're in an interest rate hiking cycle.
Yeah.
So already that's negative. But what that would do for them is it would bring capital back from the US. It'd sell the American assets, bring back here, and that might be positive for companies listed on the exchange. If you go straight into Yokohama Rubber, look, I think I consider it as an auto part, as part of the auto part industry. And the thing about it is right now, all of these auto manufacturers are trying to keep costs really down as they go into the electrification phase. So all of these auto part manufacturers would be under a lot of pressure to keep their costs of production down and the costs of these components that they bring in. And Yokohama Rubber plays into that because they make tires, they make conveyor belts and that sort of thing. So it is cheap. It has cash on the balance sheet, but I think you have to be quite aware of those nuances before jumping into it.
All right. Well, ASML, because the chips, I mean, I would think that investors had quite a good opportunity for the last few days to kind of buy the dip. Would ASML be one maybe that you could, I mean, I know that the valuations are still quite high, but just talk to me about how you're seeing ASML and if, you know, you would have found an opportunity to buy in the last few days.
So this has been this sector has been the key driver of markets over the past 6 to 12 months, and they were really hammered. I think investors need to think about a couple of things. First of all, they make chips. The whole chip making industry grew because of AI and increased applications from AI. But then in the past few weeks, we've had companies questioning whether they're actually seeing an ROI from these AI investments. So maybe it will come, and in all likelihood, it will come, but maybe it doesn't come in the next 1 or 2 years. Maybe it's a 5 or 10 year process. And these are very expensive businesses to set up. You need capacity well in advance. And remember, you also have the problem around tariffs and the fight between the US and China and everything. So this is one of those sectors which I would say at reasonable multiples, if ever they were to come, yes, it's one to consider. At stretched multiples, you really have to tread carefully. There's lots of things that can go wrong. And when you're buying at 20, 30s, and 40 multiples, your expectations of returns must be stratospheric. And in this current world right now, I would be very careful.
Well, what about banks, particularly after we had the Nedbank results out yesterday?
So SA banks did well when rates were being hiked. Because of the interest income, the fact that they're not overly extended, some of them slowed down their borrowing, so they did well. Now we're seeing the likelihood that interest rates come down, and you've seen these share prices really rally hard. The thing about it right now is that they've got a high correlation to the long bond yield, and that's come down significantly. I mean, the 10-year is down from maybe 12.5 to possibly like 10.9, give or take. Now, unless you really expect that long bond yield to go substantially lower, you would say that these banks are probably trading at fairish value, and then you would now start selecting individual stocks. I think the likelihood of higher GDP growth puts some impetus in these stocks. But again, you have to be careful. I mean, on one extreme, you have Capitec, which probably gains from non-interest revenue perspective, but is expensive relative to the other banks. And on the other side, you have Nedbank, which seems a relatively simple story. They didn't lend too much, so they don't have too much in terms of credit impairments. And then you have ABSA, which has its ongoing management internal issues. And then FirstRand, which seems to be the pallbearer for the whole sector, but it also has a high rating. So you have to pick your fighter from this perspective, I would say.
All right. Well, who else? What else is your fighter today, your stock pick, Roy?
So initially I thought I'd pick something that was interest sensitive. Then I remembered this is my long-term favorite, which is Bidcorp. So Bidcorp is a rand hedge, so I guess when the rand strengthens, you won't see much. But it plays on a long-standing theme of increased out-of-home eating, which is something we see in developed markets and in the countries where they operate. The margins continue to expand because of the ability to increase the number of products and the way they process these products and the value added there. And they're very hidden from the big macro drivers because a lot of their growth is in very fragmented markets. I don't think it's expensive at current levels. I think they've got a solid earnings growth track record and they can keep growing over the longer term. So yeah, that would be my pick for today.
All right. Well, thank you so much for your time and really your insights on what is currently moving investors' money today, Roy. That was your midday market update with Sanlam Investments' Roy Mutooni.